Good afternoon, and thank you for attending the PICPA's January Town Hall. Today on the topic of the ASC 740, preparing for year-end provision. I'm Peter Calcara, Vice President of Government Relations for the PICPA. We have two fantastic speakers lined up for you today who volunteered their time to share their expertise in this area for you. But before I introduce our speakers, please give me a minute to do some housekeeping. Number one, attendance checks. As the presentation just said, please make sure that you click on all attendance check pop-up boxes during today's program. You must click on at least 75% of those boxes to receive full credit. Number two, questions for our speakers. If you have questions during the presentation, please use the Ask the Moderator box, and the speakers will get to your questions. And third, evaluations, very important for the PICPA, and I know for our speakers. Don't forget to complete your evaluation forms. They will be sent to you via email after the conclusion of the program, and please return those. One other final note, stay tuned for some very exciting information coming up for an event the PICPA is planning in Hershey, May 31st through June 2nd. This event will include free CPE, opportunities to connect and network with your peers, which I know a lot of us are anxious to do, and also a milestone celebration and recognition of all your hard work, dedication, and support for the PICPA, the profession. So watch for more details coming to you shortly. Mark your calendars for May 31st through June 2nd in Hershey. With that, let me introduce our two speakers this afternoon. First, we have Dave Sekula. Dave is the CEO and Executive Director of Global Tax Management. Prior to his appointment as CEO, Dave served as the Managing Director, overseeing the Mid-Atlantic area, and as well as Chief Revenue Officer. Dave joined GTM in 2006 and co-founded the Tax Automation Services practice with an emphasis on tax accounting. We're also pleased to have John Williams joining us this afternoon. John is a Managing Director at Global Tax Management. He provides leadership and expertise in ASC 740 to some of the firm's largest national and multinational clients. With that, I'll turn it over to Dave and John. Thank you very much. PICPA appreciates your support and for this program. Thank you.
Great. Thanks, Peter. Well, welcome everybody, and thanks for joining. As mentioned, I'm Dave Sekula. I'm just going to go through the slides and give you a quick introduction to GTM. So if you're not familiar with Global Tax Management, we're a tax-only firm specializing in large middle market and publicly traded private and domestic organizations and those around the world. Our services, we provide a complete spectrum of tax services needed by corporate tax departments, including tax provision and compliance, indirect tax services, tax technology, credits and incentives, state and local income taxes, international tax, and transfer pricing. We provide all our services on an outsource and co-source basis, and many clients come to GTM on a co-source basis to augment resources at various times of their seasonal cyclical needs. So with that, I'm going to turn it over now to John Williams, who's going to start the presentation by taking us through a balance sheet presentation.
Thank you, Dave. As Dave mentioned, we are going to discuss a few concepts from a year-end GAAP reporting perspective. The first is balance sheet presentation. General concepts. Deferred tax balances. These should be presented as non-current assets or non-current liabilities on the balance sheet. This was ASU 2015-17 was part of FASB's simplification initiative, in which no deferred taxes would be classified as current any longer. Prior to the adoption of ASU 2015-17, I had a client that it was so complex in terms of trying to bifurcate between your deferred taxes that may reverse in the next 12 months compared to those which would reverse outside of 12 months. So it was a big relief to the tax practitioners when companies adopted this standard. Jurisdictional netting. Balance sheet presentation, basically for all your tax accounts, whether it be your payables and receivables and deferred tax balances as well. You need to evaluate the netting of those assets and liabilities by an entity's tax-paying basis, looking at jurisdictional considerations. In other words, netting of assets and liabilities is only allowed if the entities are within the same jurisdiction and have a common filing requirement. In the next slide, we'll go over a quick example of that. So you can see in column A, we're looking at the income tax payable and receivable balances. Column A is the company, and we have A, B, C, D, and E, and these are separate legal entities. The column next to that shows the jurisdiction in which we are subject to tax, and then we show whether we have a receivable balance or a payable balance in each of these entities and the jurisdictions in which they file. So pretty straightforward. You can see on the first line, Company A has a federal tax payable of $500,000, so we would reflect that as a liability on the balance sheet. But we also have receivables, Company A does, in Pennsylvania and North Carolina. We would reflect those as receivables on the balance sheet and not net them against Company A's federal payable. Company B and C, however, both file in the UK, and through group relief, payable of one entity is able to be offset with a receivable of another entity in the UK. So in that instance, we look at the payable and receivable on a net basis. Therefore, we would reflect $2,000 as a net receivable of the UK group members. Lastly, in Canada, entities D and E, Canada does not have a group relief for fiscal unity or, say, consolidated group. They are separate entity filers. Therefore, the receivable of entity D would be shown as that of a receivable of $40,000, while entity E would show a payable of $20,000. And this would be on our consolidated financial statements. We'd have a receivable of $50,000 and a payable of $520,000. That was the presentation of your income tax payable and receivable. So now we look at the deferred taxes and do the same, apply the same methodology. So with the same companies A through E, you're looking at the DTLs and DTAs, and clearly federal and state straightforward. Again, UK group relief, you net the asset and the liability and present it as a net liability in the balance sheet, and Canada would also be separately shown, such that we would have a receivable of $71,000 and a non-current liability, receivable, deferred tax asset, non-current of $71,000, and a non-current deferred tax liability of the $5,085,000. The other item that's presented on the balance sheet are your uncertain tax positions.
John, could I just make a comment real quick? If you can go back to the balance sheet presentation. The one comment I just wanted to make sure on the UK, even though it's not a consolidation or fiscal unity, normally the way you would look at it is if the attributes on the deferred taxes can, when they reverse in the future, be used in the group relief concept, they would be netted as a jurisdiction. But just note, there could be situations where when it's not a true consolidation or fiscal unity, that you might have to look and see what the individual asset components are to determine whether, if there's anything material that maybe can't net because it's not available on a group member basis. So it's something I just wanted to point out.
Now, thank you, Dave. Fair point. uncertain tax positions disclosed on the balance sheet, typically they'll be classified as non-current tax liabilities. Current classification is only allowed when the liability is expected to be settled in cash in the next 12 months. So statute lapses, there are other settlement forms that are not settled with cash should remain classified as non-current. Deferred tax assets related to deductible benefits should not be netted with the UTPs. So in other words, UTPs would typically present on a gross basis. Your liability, interest, and penalties would be the liability you would reflect on your balance sheet. So using, let's say you had a state uncertain tax position liability set up and state taxes are deductible for federal tax purposes, you would not reduce the UTP for the federal benefit of that state UTP. Similarly, if you have interest accruing on your uncertain tax position, even though that interest would be deductible for federal and state tax purposes, you would still present your UTP on a gross basis and not net it down with those benefits. The exception here, there's under ASU 2013-11, the UTP can be netted with a deferred tax carry forward attribute, think like R&D credits, NOLs, etc., if the attribute would be administratively utilized to settle the liability, or you have the option to settle the liability through the use of that attribute, and you would intend to do so. Here is a presentation or an example of the presentation of your UTP on your balance sheet. You can see that Company A has 3 UTPs, one for R&D, one for transfer pricing, and one for state nexus. Its uncertain tax position related to R&D credits is $100,000. However, we're currently carrying a deferred tax asset on that R&D attribute of $120,000. Therefore, under ASU 2013-11, we would present that as a net non-current deferred tax asset on the balance sheet of $20,000. The transfer pricing liability we would reflect as a non-current income tax payable liability on the balance sheet of $100,000. And the last item related to state nexus, we have an uncertain position of $250,000. We would reflect that as a non-current liability as a UTP of $250,000. But the fact that state taxes are deductible for federal purposes, we would set up 21% or $52,500 as a non-current deferred tax asset for the federal benefit of the state tax liability. With that, I'll send it to Dave to discuss common footnote disclosures.
All right, thanks, John. And jump to the next slide. So just in full interest of disclosure, I realize the screen looks a lot smaller than when you pull up a PowerPoint. So if I'm squinting or moving my head closer to the screen, that's a little unplanned, thought, audio-visual challenge. So, when you're looking at, the footnote disclosures, these are going to be some of the common ones, but I will talk about some of the nuances that you might encounter, preparing a financial statement and preparing, the footnote disclosures. The first one that I'm talking about here is the deferred balance disclosure. And what this requires is a disclosure of total deferred tax liabilities, total deferred tax assets, and total valuation allowance. So really what this note is doing is it's saying, if I have, fixed assets, net operating losses, and, let's say, maybe a combination of other, which could be prepaids and reserves, we want to know how much of that value is liability, how much of it is asset, and how much is valuation. So you could see something like fixed assets twice. one of the important things with this footnote is it's not necessarily designed to tie to your balance sheet. So where John talked about your balance sheet netting of deferred tax assets and liabilities, the total, of course, will tie, but the components between assets and liabilities for this disclosure will not necessarily match the balance sheet. And that's what we're talking about when we said there's not congruence between the balance sheet. The next one we'll talk about, and we'll look at some live examples, is the effective tax rate. The effective tax rate requires disclosure of items above 5% of tax that should be disclosed, in the presentation of explaining how your effective rate is compiled. And there's general SEC regulations that you can find in 240.4, but I'm just putting it in there more for reference, not for discussion. And then finally, the tabular reconciliation for uncertain tax positions. And we'll look at some live examples as we go through. But the one thing that's important with the uncertain tax positions is that reconciliation excludes interest and penalty. Some companies do include interest and penalty, but they'll include them, in discrete sections of the tabular roll forward. The tabular roll forward itself is really focused on the tax of the organization. So if I jump to the next slide, so this goes back to if you remember, John was showing an example of the balance sheet presentation. What you're seeing here is these are literally just assets and liabilities and assets of an organization. And then, of course, it's VA or valuation allowance. So you could have a situation where property, plant, and equipment is listed in both places if there's a DTA and a DTL. The next one that I'm showing here, and actually when we put this slide together, we were sort of anticipating, maybe some tax reform coming down the pike, with the Build Back Better plan. So, and trying to give you an illustration of what happens if that were implemented mid-year or retroactively for a fiscal year filer. So, your typical ETR for a calendar year filer will probably resemble column, the first column. And if you are a fiscal year filer in a year of a tax rate change that, you may have to blend it, based on a proration methodology for presentation. But since tax reform didn't really come through, this presentation was done back in like November, December timeframe. And of course, it didn't happen. So maybe just to speak though to the ETR itself, what we're seeing here are some of the common disclosures that companies would share in their ETR by component. So again, knowing that you have to disclose items of greater than 5%, you would then illustrate that in your ETR. The one thing I wanted to point out here though is if you had a situation, let's say you look at this second to last one called sale of company. If you had prior years where sale of company was, say, buried in this other line or somewhere else in the ETR, you would have to consider reformatting for the comparative years, even if it was immaterial or below the 5%. It's really just to give the reader an understanding of what are the material drivers and what did they look like in the past. Oops. And then finally, we've got the UTP schedule. And the UTP schedule, as I mentioned before, is really focused on tax only. So it's not looking at interest and penalty, but sometimes you'll see clients disclose interest and penalty in separate columns, either to provide a complete picture or there might be something of, interest or value to the reader of the financials. But the first thing we always look at is, we start with the beginning of year, then our additions to the current year. So these would be your new layers of build. Any positions that have been taken in prior years. So like maybe if you had a position for transfer pricing and then you filed your tax return and realized it had to increase, you may adjust your positions as it relates to prior years. Your reductions, remeasurements, and settlements, payments, etc. The one thing I think John mentioned earlier, when you're doing the financial statements, if a UTP is going to be actually settled in cash in less than 12 months, you would move it to your current taxes payable. Not necessarily something for this table, but just something I wanted to mention since I mentioned settlements and payments. And then finally, reductions due to statute expirations to get to our end of year balance. In many cases, I don't know how many companies always disclose the UTP liability in their financial statement presentation. They may call it other long-term liabilities, or they may call it other long-term tax liabilities. And I'm going to turn it back over to John to talk about the VAL allowance.
Thank you, Dave. Before I move forward with valuation allowance, I'm going to pull a Dave Sekula and go back to one of his slides and provide a little commentary. One note on the ETR, as you can see, this is presented on a percentage basis. You can also present it under dollars instead of percentages. There's no requirement to present under either method. And also, I think earlier David mentioned about the 5% rule. So when your tax rate is, say, 35% in 2018, 5% of 35% is 1.75%. So a rate impacting item greater than 1.75% would need to be disclosed. But you can see as the rate drops down in 2020 to 21%, 5% of 21% is only 1.05%. So what maybe didn't need to be disclosed in, say, 2018 may now need to be disclosed in 2020. All right, valuation allowance. Valuation allowance is required if it is more likely than not that some portion or all of a deferred tax asset will not be recognized. And all companies are required to test the realizability of their deferred tax assets. So what is step one? Step one is you need to analyze all positive and negative evidence. So you need to assess all available positive and negative evidence in determining whether a valuation allowance for deferred tax assets is needed. The largest item I'd say of negative evidence that we all deal with is the 3-year cumulative loss, that concept. Positive evidence would include the 4 sources of taxable income, which we'll get into shortly. The bottom line is when you are assessing the need for a valuation allowance and doing your scheduling exercise, it requires judgment. There's verifiable objective information that's going to hold greater weight than subjective information. And you have to look at what's objective, what's subjective. The more negative evidence that exists, the more positive evidence that you need to support the conclusion that a VA is not needed. Cumulative loss, negative evidence. 3-year cumulative loss. So that includes the current year and your prior 2. Typically, it's pre-tax plus permanent adjustments and consideration of aberrational items. What would an aberrational item be? It could be, say, a goodwill impairment, if you've never historically had goodwill impairments. It could be a one-time write-down of an asset. Perhaps you went through a transaction and incurred significant transaction costs. Those are items that could be considered aberrational and removed from your 3-year cumulative loss analysis. However, it is most important that you will want to have these discussions with your auditors. I think as some of the future slides that we go through, Dave will say the same thing. A lot of this is really discussing it upfront with your auditors to understand what their position is. Third bullet point down, you note that some firms, their position is it is only GAAP pre-tax book income without consideration of aberrational items. The 3-year cumulative loss cannot be the sole measure for the need to have or not have valuation allowance, but it is considered significant. So the 3-year cumulative loss is very objective. It's objective evidence because it's based on actual results of the prior year and the 2 prior, the current year and the 2 priors, apologies. So we need more positive evidence to outweigh this negative evidence if we are in a 3-year cumulative loss position. So what are sources of taxable income that would provide positive evidence? So you have to go through and assess the 4 sources of income. The first source is taxable income in a carryback period. So Imagine if you have, for example, an R&D credit that can be carried back, or an NOL tax attribute that can be carried back to a prior year and utilized. That would be an objective source of positive evidence. Future reversal of existing temporary differences. This is really comes down to a scheduling exercise. Are your DTLs in excess of your DTAs? And based on the reversal period of those DTLs, would they provide enough taxable income to utilize all of your DTAs? The third source of positive evidence are tax planning strategies. Dave's going to explain these further, but basically comes down to, is there a planning strategy that a company could implement in order to have a deferred tax asset not expire unutilized, an NOL or a credit? And the fourth source of positive evidence would be future taxable income exclusive of reversing temporary differences. So, what is the outlook of the company's operations going forward, and can you include that in your scheduling exercise? Note, if any one source of taxable income provides sufficient evidence to eliminate the need for valuation allowance, then other sources do not need to be considered. So if sources 1 and 2 are enough that I do not need a valuation allowance, then I would not need to necessarily look into tax planning strategies or look into future projections of taxable income. Lastly, uncertain tax positions, or FIN 48 liabilities, do need to be considered as a source of taxable income in your modeling. Carry forward attributes, NOLs, and credits. You need to be cognizant of the type of assets and liabilities that you have and the jurisdictions to which they belong. So, for instance, tax jurisdictions, think federal versus state. There are state NOL limitations in, for instance, Pennsylvania and Connecticut that could limit or it could affect the scheduling and reversal of your deferred assets and utilization of those that you just need to be cognizant of. If you have a capital loss carried forward and that capital loss can only be used, only capital income can be utilized to offset that capital loss versus ordinary income, you want to be cognizant of that as well. Lastly, you may have surly limitations of your NOLs or 382 limitations on your NOLs that you also need to consider when analyzing the utilization of your NOL and credit attributes. Treatment of non-expiring carry forward attributes. This is an interesting one. It's but you still must evaluate whether or not you think that attribute will be realized. You cannot, the last bullet point, you cannot assume that since a deferred tax asset or on an NOL can be carried forward indefinitely, that you would not need to apply a valuation allowance against that attribute. In here I'm thinking, I wrote down a couple of notes, with tax reform, post 2017 US NOLs have an unlimited carry forward life, but the future utilization of those NOLs is limited to 80% of future years' taxable income. There are foreign NOLs in Denmark and maybe the UK where they have an unlimited life, but just because an attribute has an unlimited carry forward life does not mean it does not need a VA. Future reversal of existing temporary difference. This is that scheduling exercise that I talked about as a source of income, as a second source of income, if I recall. So you need to take all your assets and liabilities as of your balance sheet date and apply some type of a subjective expected reversal period. So for example, if I have a federal net operating loss of $100,000 and that NOL expires in 10 years in this example, but I also have deferred tax liabilities of $200,000 as of the balance sheet that will also reverse within the next 10 years. My $200,000 of deferred tax liabilities, as they reverse, they create taxable income in the future. And that taxable income will be used to realize the benefit of the NOLs that I have. So based on this simple example, the DTAs will create sufficient taxable income to cover the NOL DTA that we have, and no VA would be required. Now, down in the consideration section, though, if my DTLs are going to reverse in a period after 10 years or have an indefinite life, and we're going to get into the definite life deferred tax assets and liabilities next, then some or all of the DTL may not be used as a basis for future taxable income, and a VA would need to be established on some or all of the NOL DTA that we have. Indefinite-lived deferred tax assets and liabilities. So an indefinite-lived deferred tax liability is an instance where you have a book basis in excess of tax basis. The most common is goodwill that I see in practice. Clearly land, may have that as well, but goodwill is the one that we deal with the most. Foreign exchange gains and losses. And the reason why it's considered indefinite-lived is that you cannot predict when that the reversal is non-predictable. I can't say when I'm going to impair goodwill, for instance. And so if the reversal is not predictable, that's considered an indefinite-lived deferred tax liability, and that's often referred to as a naked credit. Indefinite-lived deferred tax assets. 2 slides ago, we talked about NOLs and how post-tax reform in the U.S., post-2017 net operating losses can be carried forward indefinitely. So examples of indefinite-lived deferred tax assets would include net operating losses, a 163J limitations. So if you have disallowed interest under 163J, that can also be carried forward indefinitely. Keep in mind, though, as I mentioned earlier, net operating losses generated post-2017, while they have an indefinite life carry forward, the utilization of those NOLs is limited to 80% of future years' taxable income. So here's an example of a schedule and exercise with the naked credit. So assume that the company has negative evidence such that we do need to set up a full valuation allowance. The other fact is the company has tax-deductible component 1 goodwill, and the book over tax basis is $100,000. So for this exercise, let's just assume that book basis and goodwill is $500,000, tax basis is $400,000. That creates a deferred tax liability of $100,000 on that basis difference. I look at my ending balance sheet, and at the end of the year, I've got deferred tax assets on bad debts, payrolls, inventory reserve. I've got net operating losses, which create deferred tax, which are deferred tax assets as well, some of which expire and some of which are unlimited in their carry forward life. And lastly, I have my deferred tax liability on goodwill, which is indefinite lived. So I've noted the liability that I noted ID next to is indefinite lived deferred tax liability, and I've got indefinite lived deferred tax asset on that NOL. So, but the utilization of the NOL generated post 2017 is limited to 80% of future taxable income. So when I schedule out the reversal of this $100,000 deferred tax liability and it creates taxable income in a future year, only 80% of that future taxable income can be offset with my indefinite lived NOL. So at the end of the day, I've done a little box down here to try and just prove it out. But if I have a deferred tax liability on a definite lived intangible of $100,000, the percentage of my deferred tax liability that cannot be used to offset the DTA on my post-2017 NOL is 20%. Then I'm going to be left with a deferred tax liability of $20,000. That's what I'll have to record on my balance sheet. Therefore, if my gross deferreds are an asset position of $535,000, and I need a liability of $20,000, then my VA needed is $555,000. And that $555,000, in the way I view it, is I need VA on my bad debt, accrued payroll, inventory reserve, on my NOL that's going to expire, the $200,000. So that total right there is $335,000. And if I can only use $80,000 of my $300,000 indefinite life NOL, then I need an additional $220,000 VA on my indefinite life NOL, bringing my total VA need to $555,000. With that, I will send it back to Dave to discuss tax planning strategies.
All right. Thanks, John. So when looking at tax planning strategies as a option to realize deferred tax assets, the first one is, they have to be prudent and feasible. They have to be something that the company can do. It's in their control, and it's a planning strategy that someone would reasonably undergo. But the real gist of the tax planning strategies is, control, reasonableness, and making sure they're just in general that they're feasible for the company to produce. The strategy, as it mentions in this next bullet point, strategy the company would not ordinarily take, but would take to prevent an operating loss or tax credit from expiring. So it doesn't necessarily mean that it's in your arsenal of planning ideas, but if you said, hey, we're otherwise going to lose this and we want to accelerate these tax attributes before we before they expire, and maybe that defers other tax planning ideas. But the ultimate result is that it would realize a deferred tax asset or avoid or release a valuation allowance. So just things about tax planning strategies. They can accelerate taxable income to utilize carry forwards. And that's probably the one I see the most. Where we get into the change of character of income or change of taxability of income, they're probably not as common. It's really the acceleration most times of tax attributes that you'll see in many tax strategies or some kind of tax-free reorganization. We can go through some of these examples, probably not so common on some of them, but one of the ones I want to really focus on, and I'll let you kind of read through these. I won't read through each one of them. The acceleration of, temporary differences or even carryback claims and carryback, aspects of federal compliance. Those are probably some of the more common ones, where you see the filing of a consolidated or combined return. I've seen that, obviously in the state side, and you might see that, sometimes in the, global consolidated world. But those are probably some of the more common ones that we see, particularly when you get into accelerating the reversal of temporary differences. That's also where you might also see method changes or something along the lines that would either slow down or accelerate taxable incomes or deductions that would, ultimately facilitate your goal. Examples that wouldn't qualify, again, I'll sort of let you read through them. But again, going back to the overall concept of, where it's prudent, it's reasonable, and it's something a company would do, that's really the goal here. And I think the one where it says like, selling patents, trademarks that are essential to future operations, like certain assumptions, you can't make if they're really not going to improve the quality of the organization, or you're not even in control to do it. It's not prudent to do it. At the end of the day, the tax planning strategy concept is something that you can implement and have in control. I have seen situations where companies can also, as long as they have control of a strategy, they may not necessarily have to implement it. So going back to John's comment on maybe some of the asset attributes that don't have expiring lives, you may have a situation where you could restructure or trigger some sort of event to realize that asset, but you decide, I don't want to do that this year. It is in my control. It's prudent to do. It's easy to do. So I think even just having the documentation approach of a prudent planning tax strategy would be enough to substantiate, a position to not put up a VA. Future taxable income, so the use of projections. When you get the projections, the important thing is to understand, that you are consistent with management. You want to make sure that whatever you're telling Wall Street, whatever you're telling your creditors, whatever you're telling, other stakeholders in the business from a financial projection standpoint, that's what the tax department should be using. You want to make sure that, we're all telling the same story, and tax isn't owning a projection that may not be substantiated in other methods of the business. So the real gist of the use of projections is to make sure if you're relying on it from finance, you're confirming what you're using it for and whether that's inconsistent with what they're doing with anything that they're telling other stakeholders or bank covenants, et cetera. And you also want to avoid the arbitrary cutoff of years projected. So you certainly want to make sure it's reasonable and feasible, and you should also talk to your auditors about your approach to make sure that they're in agreement, so that's not a surprise when they go to review it. Looking at future taxable income, one thing I just wanted to comment on, when John went through the slide deck earlier and talks about the 4 sources of income, the way I think most people look at those, if not all audit firms, is that they become less and less objective, they become more subjective as you go down that list. So when you start to get into tax planning strategies and then future taxable income, you can kind of use that list as what's most objective to least objective. That might not be fair in your situation, but I think when you look at how people order the list or work off the sources of income, it's you'll usually see it in more of a chronological order. But the use of future taxable income projections, the focus a lot of times is future book income and permanent differences. You can look at temporary differences, including future originating ones, but you got to remember they're gonna flip over time. So they're gonna come back and just reverse at a future period. Typically, though, when you are looking forward, that's typically when you exclude aberrational items. So like John mentioned, if you had like a significant impairment or maybe a settlement or discontinued operations or extraordinary event, you would not factor those into your future taxable income. You would want to look at things from the perspective of, hey, what does normal operations look like in the future, and things that we wouldn't otherwise forecast because they're not, part of our normal operations. Certainly, again, when you get into future taxable income, because it becomes more subjective than other measures, you will want to discuss with your auditors. So scheduling differences, we talked about scheduling differences as being one of the sources of income, and how to kind of go about that process. One thing, if you're audited by the big 4 firms, a lot of them have guides and guide-ins on taking scheduling exercises. But in general, when you get to a scheduling exercise, because you're in a 3-year cum loss, the assumption is typically that your projections are no longer reliable to project profit. So you usually assume profit is 0, and now you apply your inventory of deferred tax assets and liabilities and consistently amortize them over a period until they're wound up. The process for doing that, again, your auditors will have various forms of guidance. So you want to just make sure if they have a thought process and how you should do it, then that's probably the guidance you should follow. Some of them are very simplistic. If you had current assets, say like a bad debt reserve, well, the assumption is a current asset reverses or realizes in 1 year. So you may just reverse it over 1 year. I have seen situations where current assets may have been reversed over more than 1 year. So again, when you come up with that process, you'll want to maybe consult with your audit firm's guidance, consult with your audit firm, and also just make sure that you apply it consistently between years as you advance. The reason I say you may want to look at the guidance, there's an example down here where if the book life exceeds the tax life, if the tax life exceeds the book life, then once you get to the end of the book life, you should basically ignore the rest of the tax life. And the reason there is because the assumption is that a company puts a book life on an asset with the expectation of replacement or disposal. So let's look at a quick example. Here's our fact pattern. Negative evidence says we need a full VAL allowance. Company has an NOL at the end of the period within 3 years. Company has an NOL at the end of the period with 3 years remaining prior to expiration. So this is probably one of our 2017 NOLs. And then the tax assets are depreciating 4 years faster than the book assets. So there's some acceleration in the tax assets. So let's look at our assumptions that we made. Again, your fact pattern and how you apply what we're discussing here will be up to you, but just to kind of go through this example. So in my example, I'm saying, okay, right away, I'm going to reverse my bad debt, payroll, and inventory reserve because those are current assets, and I'm going to assume they're going to reverse in 1 year. But in doing this reversing exercise, I need to know that if that was my only source of income, the reversal of those temporary differences, it would create an NOL. Pardon me. So that NOL is now part of my post-2017 NOL process. So therefore, I now have an NOL building as a result of these temporary assets reversing. So now, as I mentioned in my fact pattern, I'm going to make the assumption that book and tax for the next 4 years or 3 years at least are going to be the same because I said, it's not till year 4 that my book depreciation starts to exceed my tax depreciation. So if I had a net DTL and I get out to year 4, I've already lost my 3-year asset. I can't tell if that says 3 or 5, but it should say 3-year. But I should have lost my 3-year NOL. At this point, it's now expired. So now the NOL that I've generated through my hypothetical scheduling exercise is all I have that I can use to offset, this DTL. And then that remaining DTL, which will expire after, year 2025, will now also have 80% coverage for the NOL that was created from these reversing assets. So therefore, I feel very comfortable that I'm going to realize these assets. I'm going to realize, my depreciation, but unfortunately, my net operating loss is going to expire before I get to utilize it. And therefore, that tells me I need a $100,000 valuation allowance for my 2017 or pre-2007 or 18 net operating loss. And that brings me down to a net DTL of $65,000. So I'm going to turn it back over to John now to talk through return to provision.
Thanks, Dave. So far, we discussed balance sheet presentation, footnote disclosure, and valuation allowance. The final topic is return to provision. Return to provision considerations. First, confirm the categorization of your adjustments by permanent items and temporary items. You want to review the return for general business credits that were generated but not utilized or even provided for previously. You want to review the carry forward of your attributes like net operating losses and credits and compare them to the deferred tax balances that you're carrying and adjust them if necessary to agree to the tax return that you filed. You want to prove the net tax expense out to confirm that the expected impact of your permanent items is what falls out in tax expense and that temporary items are properly offsetting. In other words, a temporary item should affect your current and have an equal offset to your non-current. You want to agree your adjusted beginning year balances to their source. So for instance, if I have a deferred tax asset on accrued bad debts, I should be able to tie that balance out to the trial balance. And lastly, you want to prove out your payable. The best practice is to have your RTP drafted and signed off on prior to filing your return. either walking it through with the CFO, CAO, or tax director, whomever that may be. And the last comment is that auditors are typically going to inquire about your RTPs that affect the ETR and ask, is that a change in a prior year estimate or is that an error in prior year? For example, we filed a return with the tax due of $3,150. We made a payment with the return for the $3,150. We have a foreign tax credit that was generated in the return and not utilized of $10,000. And we had a bonus accrual that was fully paid before March 15th and therefore fixed and determinable for tax purposes. Column A, from a provision perspective, I know we only have a few minutes left here because we do want to leave time for questions. So I'm going to drop down. Column A is the provision, and you can see that we had taxable income of $140,000 at the time of the provision, generated a current tax payable of $29,400. Column B, in the return, when we filed it, we had taxable income of $155,000 and a tax liability of $32,550. So just by comparing the bottom line of columns A and column B, we would have an increase in the federal tax due of $3,150. That would be a debit to current tax expense and credit to taxes payable. After we analyze the current impact, we then move on to the deferred. In the deferred context, we've got beginning of year deferred tax assets with a carrying balance of $16,800. And that's based on multiple different
Oh, John, I think you went on mute or somehow got removed from the. Maybe I can just jump in here. Are you okay? So I apologize. I'll kind of just pick up from here. I think we're looking at the computation of deferred impact, and we'll kind of make this fast because I know we're running up against time. So effectively what we're doing is we're truing up our there you go. You want to?
Yep. So sorry. Yeah, it was a little difficulty there. Basically, we're truing up our deferred tax asset balance from $16,800 to an asset balance of $18,400. You can see in the adjusted beginning of year. And that is all related to the fact that in the return, we took more deductions to the tune of $40,000. And we also generated a foreign tax credit, which we're carrying forward for $1,600. So in this example, this would say I need to debit my deferred tax asset and I need to credit deferred tax expense. So when you look at the total, I had an impact to my current provision. We said debit current expense $3,150. From a deferred perspective, I need to credit deferred expense for $1,600, which leaves my net P&L impact to be $1,550. And that net impact can be proved out by just looking at the permanent items that we had and the differences between the provision and return. When you sum up the permanent items related to M&E and 162M, along with the benefit of the foreign tax credit, the sum of those permanent items is $1,550, and that gives you assurance that you've computed your RTP properly and its impact to tax expense in your total tax expense. Lastly, on your payable proof, it's just looking at if I were to settle up all taxes owed to me, get those refunded, pay all the taxes that I owe, what would my expected payable balance be? In this example, if I start with zero payable and have my return to provision and then I make the payment, literally I'm left with taxes on account of $30,000. If I have a current year provision of $45,000, I should have a payable of $15,000. This exercise, it's best practice. This is exercise that we've shown here is very straightforward and easy. It can get much more complicated when you are looking at multiple states as well as non-U.S. jurisdictions and proving your payable out, but it's a well worthwhile exercise. So with that, I'm going to send it over to Dave.
All right. I haven't seen any questions come through the queue, so certainly if anybody has any questions, please feel free to ask them. As far as anything new from the audit perspective, or the financial close perspective, any trends or anything we're seeing, haven't seen too much different from last year. I think it's been pretty steady state. So nothing new in analytics disclosure practices from 2020's fiscal year end for the 2021 fiscal year end. But I don't see any questions coming through. I'll give it maybe just one more minute. But if not, what I will say to everybody is thank you for joining. We certainly appreciate your attendance today, and you have our contact information. So certainly feel free to reach out to us. And I want to thank the PICPA for inviting us to present today. And it doesn't appear we have any other questions. So with that, we will conclude our session.